Joseph Jaffe. I believe that's a Japanese name. And but I tell you what, he's not famous. He's famouser than he was, or used to was. But fame is fleeting, like a paperweight. It just comes and goes.
Am I being overconfident? Am I becoming complacent about complacency?
I think you are.
Oh, he's not the Messiah. He's just a very naughty boy.
Yeah, I've got big ears.
Brian doesn't want to see anyone else. Piss off.
That's the one. Because you literally complete me, and we complete each other.
You've obviously encountered discrimination in your own life by virtue of being Australian. So,
hey, Manuel Kant was a real pissant who was very rarely stable.
I don't want to get too gushy, but I might just be saying you complete me, Dean. PNG now stands for Pritchard and Good.
Branding is not a bad blind date. Look at you! You are insane!
How did I do that?
You're
How
insane!
Did I do
that?
You're insane! Happy New Year, everybody. It is 2024 and everything is new and nothing is new. It is a new year. It is a new world. It is a new compendium, a new Pandora's box, if you will, of potential, of possibilities. I am walking and chewing gum at the same time. We're actually live on Instagram for the very first time, which is super cool that I can be. So I'm like going backwards and forwards and thinking, is this thing on? Is this thing on? Is this thing working? It's kind of exciting to be able to always, I love it. I love being able to experiment. I don't like being comfortable. I like being comfortable with being uncomfortable, if that makes any sense. What's that? Oh, my director said nothing because I don't have a director, but it doesn't matter. So we'll see if comments come in from Instagram. We'll put them on the screen. You know, it's awesome, right? It's awesome. If we are not growing, then we are standing still. And if we are standing still, then we, my friends, are dying. Well, here's someone who is not dying. He's very much alive. Alive and in the green room, Victor Haghani, who just wrote a book, not just a book, one hell of a book. In fact, according to The Economist, one of the books of the year, it's called The Missing Billionaires. By the way, I've got to tell Victor, it looks like you need to get back to the printer because a bit of the typeface kind of is rubbing off. Just kidding, just kidding. It is a book that I've read 17 times, back to front, front to back, inside out, outside in. And I have some good news and bad news for you, Victor. I'm not one of the missing billionaires. As much as I'd like to be, I'm just not one of the missing billionaires. But the subtitle of the book is A Guide to Better Financial Decisions. It almost sounds like a mea culpa, confessions of my entire life, all the bad decisions I've made up until this point, until meeting Victor. And he will be on the show shortly. Look, it's a new year with new possibilities. And one of the things that I'm super excited about is I have a new book. And I haven't really announced it. I'm still not officially announcing it. But the book is called Forever Changed, How a Global Pandemic Changed My Direction, My Purpose, and My Life. It is part memoir and part motivational book, self-help book. You can check it out at foreverchange.life. It is also the world's first book where readers get royalties. So 10% of the royalties will be shared by readers. And if you'd like to be amongst the first in the world to be able to buy one of the thousand royalty NFTs, you can do that by going to foreverchange.life. I think it's pretty cool, don't you? Also, I'll be talking a little bit more about my coaching business. I started business and leadership coaching with the entrepreneurial operating system, helping small and medium businesses get vision, traction, healthy, and getting what they want from their business. And again, I'll be talking a little bit more about that. I've been, just focused on head down, doing the, getting everything done that I need to get done. But now it's time to share a little bit. I just didn't want to distract from my baby. And my baby is the show. The show has been my life force. The show saved my life when March 2020 hit. And I decided, against all the good advice that has ever been given to me with a face for radio, that would make sense for me to become a talk show host, the daily show for business, with a little bit of Wayne's World thrown in for good measure. If you like the show, please subscribe at bit.ly/subscribe to the show. And then every Monday through Friday, 8 to 9 a.m. Eastern Standard Time, I do a virtual coffee. Really am proving that I have a face for radio and a voice for TV. I don't even know how that works. But we do 1 hour of audio first, audio only thought leadership in the Collective Cafe. We do that in discord.gg/Alpha Collective. We're experimenting on X Spaces, maybe going back to Clubhouse. We'll see how that transpires. Just did an amazing session a few weeks ago on Elon Musk, him basically telling the advertising world what they could do with themselves. And it involved a word beginning with F, with 4 letters. And I think you can work that one out. And then just this week, I put out one that really talks about Gino Wickman, the founder of EOS. He says that in 2,000 sessions and 14,000 hours of working with small and medium businesses of privately held companies, 10 to 250 employees, he found out that without question, there isn't even a close second. The number one contributor to a company's success, a business's success, is a strong leadership team. There is no close second. And I wrote an article on that. And if you can't join us live in the morning, you can actually download the pod version, and you can subscribe by going to bit.ly/collective cafe to go. So there you have it. It is now time, as always, to get into the seated soliloquy, because I'm sitting and it's a monologue. And in homage to my guest today, it is called Buy Low and Sell High. Now, I got to tell you that I'm no genius, and I mean it. I am not a genius when it comes to investing. Shall we just say I'm financially challenged? I'm investing challenged. Every good decision that I've ever made, well, actually, there haven't been any good decisions. But every decision I've made, if you did the exact opposite, you would today be one of those missing billionaires. But I think it's as simple as this, right? You should buy low and sell high. Isn't that the goal? Well, if only it were that easy. I heard the other day that actually no one really quite knows the high and the low. You never quite know. No one has ever quite figured it out. You like to believe that you're buying at the low. You'd like to believe you're selling at the high, but it doesn't always work out that way. You know, I've gone through my own stints and stages. I remember during the dot-com boom and bust, the bubble. I remember going into my HQ global workplace one day, and Yahoo was up $64. And I would open up my day trading software, and I just see all the little blinking lights, the reds and the greens. What I didn't realize is that I was in a casino, and of course we know the house always wins. But what if there was a way to be able to invest smartly? the mixture between active and passive. Well, I'm just priming the pump for my guest who's about to come on the show, that actually talks about this idea of how to do this the right way. And it's at such a good time in our lives to be having this discussion, because we are, in the midst, of the SEC passing down a decision on ETFs. I say EFTs, ETFs, NFTs, I don't know, ABCs, etc. But where will the world lead, and where will the world land when we think about decentralized currency, when we think about from barter economics and barter markets to gold bullion and gold standards to paper money, bonds, I should say, paper money, moving into digital and ultimately peer-to-peer based currency, and now cryptocurrency. It's a very interesting world, and it's an interesting time. But at the end of the day, I think it's more than just buy low, sell high. It's about this idea of how do we create not just wealth, but generational wealth. How do we leave our families in a better place than when we found them? Maybe that is a little bit more of a profound insight. And now it's time, actually, speaking of insight, to get into the insight from Victor Haghani. Victor Haghani started his career in 1984 at Solomon Brothers, where he became a managing director in the bond arbitrage group run by John Meriwether. In 1993, Victor was a co-founding partner of long-term capital management. He founded Elm Wealth in 2011 to help clients, including his own family, sustainably manage and preserve their wealth with a thoughtful, research-based, and cost-effective approach that covers not just investment management, but also broader decisions about wealth and finances. In his TEDx talk, "Where Are All the Billionaires and Why Should We Care?" Victor shares his unique perspective on active versus passive investing. He has become a prolific contributor to the academic and practitioner finance literature, and is co-author of The Missing Billionaires, A Guide to Better Financial Decisions, just published by Wiley. Victor, welcome to the show.
Thank you, Joe. I love that whole introduction. That was so much fun, especially the marching band.
Listen, I've got all these celebrities. For someone not famous, I sure as hell know a lot of celebrities. In fact, let me just see if one of my very, very good friends is around. Where is he? He sometimes hides. He's a little bit bashful, but he's been quite vocal regarding the whole EFT, ETF, EFT. I've got to find it. Here he is.
Joseph Jaffe is not famous. I'm famous. Joseph Jaffe is a delusional human being who thinks he's famous. He's not famous. He's not famous. I'm famous.
Well, there you go. Scaramucci himself. We're very tight, Victor. We're like that. That's him and that's me. So there you go.
Wow, I never saw him in casual outfit like that before.
I mean, it was either him or George Santos. So I take what I can get.
Yeah. It was surprising to see him not in his normal Brioni.
Well, you know what, and he's also doing something with the hair, no doubt, as well. So you and I would have different perspectives about hair to him. But anyway, enough about Scaramucci, and let's look. We're going to talk about investing. We're going to talk about active investing. I watched the TED Talk. I absolutely loved it, and I've got a couple of clips that will set it up, because I thought you did just such a brilliant job, and I loved the animation, that I was like, you know what? Why recreate the wheel when we can just repurpose it? But let's stay on the ridiculous before we get into the sublime. And let me ask you a question. Are you ready to play Two Truths and a Lie?
I am.
And
I'm
even
ready.
if you said no, I was going to be, well, too bad. We're playing two truths and a lie. So you see, I don't know whether, I don't know if we should be mixing creativity and accounting or finance, but we're going to see how good you lie, my friend. All right.
Okay, I've got my poker face on. I'm ready.
Right, so we sent our investors, our investigators into the field. It's been a while. I'm rusty. I haven't done a show in a couple of weeks, and we found out a couple of interesting truths about you. I didn't even get to the unicycle, by the way. You're now since 2020, you're a unicycle aficionado. So if anyone needs lessons, go to Victor. But this is what we found out.
I know the secret. I know the secret to learning to unicycle past the age of 20.
All right, so there you go. I mean, some people might come to you for investing advice. Others might come to you for unicycles, but it's all good. So here's the first thing. Now, I did not even know that this was a thing, but apparently you are an avid practitioner of underwater basket weaving. Yes, I Googled it, and it is a thing. Can you please explain to me, first of all, why you are an avid practitioner of underwater basket weaving, and why you don't need and how you breathe underwater, apparently?
Well, first of all, it's beautiful down there. I think we can all agree on that. And there's lots of company with all the fish and crustaceans moving around. But the real the beauty of basket weaving underwater is that you're sort of in an almost zero-G environment. So your threads are all much easier to manage as opposed to doing it outside of the water, where everything, it would kind of be like doing basket weaving in outer space. So when that comes and becomes affordable, I'm sure people will be moving to doing that in space rather than underwater. But that's the attraction.
Yeah, I'm fairly certain that Elon Musk versus Jeff Bezos, who will be the first person to do outer space basket weaving? Watch this space. Well, Victor, here's something else about you, which might be true and it might not be true at all. But your first pet was a snake, and you got it to cheer you up after breaking your leg when you were about 8. And then you took it to school. And by the way, you haven't aged a day since you were 8. So that's another interest. I mean, there is so much that more to you than meets the eye.
Yes, well, that's it. Actually, there's a little bit more to the story. So I broke my leg. My parents were separated. I was living with my mother. I broke my leg. My father was, thought that my mother wasn't doing a very good job of looking after me. So when I visited my father, he said, let me cheer you up. Let's go to the pet store and I'll buy you a pet, that you can take home. And when I looked at the snake and expressed interest, I think that my father's eyes just lit up, knowing or imagining, what my mother's reaction would be when I turned up with the snake at home. So, she wasn't too pleased about that. And then, I couldn't leave the snake at home when I started to go back to school. And so I took the snake to school. I used to keep it down inside my cast. And then, at some point, the snake popped its head out. My first grade teacher went crazy. I got sent to the principal's office. My mom had to leave work and pick me up. And that's my snake story.
Look, all I know is if you told a story about a snake popping out of your clothing in 2024, you'd probably get canceled. So thank God this happened back in the day. So we now have 2 stories, and if you think you know which one is true, which one is false, I should say. I'm thinking they all sound false and they all sound true. All you have to do is go to 2T1L_Victor Haghani, bit.ly, and you could win $1 million. And that might be a lie, so we're not quite sure. So Victor, we have one more, and I just want to apologize in advance for the graphic that will accompany this one. You will no doubt be regretting coming on the show, but apparently you shave your armpits, and you would recommend all men and women follow your lead. This is the only photo that we got So again, my apologies. But I think people, if they look close enough, they would realize that maybe there's a little bit of Photoshop involved. But tell us about what are the benefits of armpit shaving?
Well, the first one is you don't need to use deodorant. And, that all those little, microbes that like to live in the hair under your armpits don't have any place to live. They might go elsewhere. I'm not suggesting that we shave our chests and so on, but, the armpits get really warm. So, that's your main benefit is you don't need to use deodorants, which are probably not very good for us, probably not good for the environment. And, by not buying Starbucks, you can save up the money on deodorant and have a better retirement.
Well, listen, so we are just going to leave it there, my friends. If you think you know which one was the lie, I could have asked you to actually show us, but I didn't. We're going to leave the ridiculous. And Victor, we're going to move to sublime. Exactly. You're a good liar, my friend. I'll tell you, as I said, it's 2024. It is a year of new beginnings. It feels like a good year with 2s and 4s, and 2 times 2 is 4. And one of the reasons why I started the show was to bring a different side to business and marketing. Business and marketing sometimes can be so serious. And when you see people on a CNBC or whatever the case may be, or Cheddar, everything's very, very serious. But when we actually understand the human being, the personality, the story behind, we see people in a different light. And so thank you for being a sport and playing along, Victor. But now we're gonna focus on finding those missing billionaires, because we don't know what happened to them. They've gone into hiding. They've disappeared. It's all related to your book, The Missing Billionaires. And, I thought I would set it up with this wonderful, wonderful clip from your TED Talk. And then we'll be back in a second and we'll discuss.
The puzzle of the missing billionaires. Let's start with this fact. $1 million invested passively in the US stock market in 1900 would have grown to $30 billion today. Ka-ching. Now, you might say, wait a second, $1 million was a lot of money in 1900, and you'd be right, it was. However, historical records indicate that we had 4,000 millionaires in the US in 1900. Now, if each one of those millionaire families had children at the average rate, we would have 30 families living today for each one millionaire family back then, which conveniently means that those 4,000 millionaire families in 1900 would have spawned 120,000 billionaire families living today if only their investments had been able to match the return of a passive investment in the US stock market. Now, according to Forbes magazine, we've only got 400 billionaires in the US today, and virtually none of them derived their billions from their ancestors' millions in 1900. So what happened to the other 119,600, or 99.7% of them? Was it so impossibly difficult to match the returns of a passive investment in the US stock market? Well, evidently it was. And that's exactly the point I want you to take away from all these missing billionaires, just how incredibly challenging it is to capture the returns offered by the market. What makes it so difficult?
Okay, so I love the setup. I love this idea that there were 4,000 millionaire families in 1900 that today could have been 120,000 billionaire families, but there are now 4. So there are a couple of things going on. One of the things is that stands out like a sore thumb to me is this idea of investing, putting your money away and leaving your money and not touching your money. Is that possibly what happened to so many of these billionaires, that they were not able to stay the course?
Well, before we start, I just want to really be clear that I'm not mourning the lack of these dynastic billionaire families. So the fact that we don't have 120,000 billionaires today that that it basically inherited their wealth from their families in 1900 and grew and all of that is not something that I think we need to be sad about or whatever.
Right,
I mean,
because then they would have all bought Twitter. So
yeah, I mean,
let's just be clear.
Yeah, and so I just want to be clear about that. This is not a, I'm not thinking, oh, it would be wonderful if we had a lot more billionaires today. By no means, do I believe that.
All right, noted.
But this is really, the story or the metaphor here is that, boy, making good financial decisions must be so difficult that nobody is able to maintain. It's like nobody has been able to maintain their relative wealth over the last 120 years. Like no family has been able to do that. That when we take account of how the families grow and taxes and spending and all of that, we should be seeing all of these billionaire families descended from back then, not to mention all the other families that that became wealthy, since then and have come and gone. So it's really it's the canary in the coal mine. It's really the sign that there's some difficult things with financial decision making. What are they? What might account for these missing billionaires? And as I say, it's not that we were in a bad investment environment. It's not taxes. We don't think. It's not even philanthropy. We can look and see that on average, very, very wealthy families give away about 0.5% of their wealth per annum on average, with some giving away very little and others giving away a lot more. So we should see, a lot more of these very wealthy families, but we don't. And our hypothesis, which we really go into in detail in our book, is that we're pretty ill-equipped to make good risk decisions. That we think that the best hypothesis for what happened to these families along the way is that either that in their investment portfolios they took an inappropriate amount of risk, that they either took way too much risk. I think that happened in a lot of the cases, very concentrated portfolios in assets that they felt that they understood very well, or sectors where they made their fortunes to begin with. So the Vanderbilts, throughout the life of the Vanderbilt family, they were very heavily invested in transportation. That's where Cornelius Vanderbilt started in railroads and transportation, right up until the 1960s, when finally their fortune really evaporated with the bankruptcy of Penn Central and so on. And so either too much risk, in some cases, hardly any risk at all. Maybe they were some of the families might have been too invested in treasury bills the whole time and missed out on the economic boom in the developed world. And then combined with that, making spending decisions where the spending decisions were not aligned with their investment risk decisions. So, families sort of locking themselves into a relatively fixed and too high level of spending relative to the assets and risks that they're taking on the other side. So we think a lot of it has to do with making poor or inconsistent risk decisions that wound up eating up a lot of that wealth over time, over long periods of time. It doesn't happen right away, but over 30, 40, 50 years, those effects can be really big.
I said earlier that I was financially and investing challenged, but what I do know a thing or two about is marketing and understanding culture and technology and trends. And it does seem that many of these billionaires, certainly from 1900 onwards, they caught a wave, whether it was luck or skill. When we think about steel and coal and and transportation and railway infrastructure, but the world changes, and I guess on one hand, it's almost, is it possible that we'll see an Elon, a Jeff, a Bill, one of these billionaires today being able to move with the times to be able to continue to innovate and be ahead of that wave, as opposed to, cresting or being dumped by the wave, if you will?
Boy, well, I think that trying to make sense of what the super wealthy, top 50 wealthy people in a society do is like, I'm not sure what motivates them. I mean, obviously, if we look at the things that Elon says or that Jeff Bezos say, we can see that they're motivated by some pretty non-financial goals, trying to save humanity and allow us to spread out over the solar system and beyond and things like that. So I think that, whatever financial decisions Elon Musk makes, at his level of wealth, it's kind of irrelevant to the rest of us as we seek to make better financial decisions for you, for me, for the listeners and viewers of our discussion. And I think that earning the harvesting the returns that are available in the market efficiently from a point of view of risk, of cost, of fees, of taxes, that's the best that we can do. We're not, none of us is going to found the next Amazon, or very unlikely. I mean, somebody will, but the odds are against anybody, founding a $1 billion business, and all the financial decisions that go around that. But what we do need to really think about is, how do we manage our own savings if we're in a situation where we can put away 10 to 20% of our earnings each year and try to build that up for our own retirement, for our own for bequesting, for gifting to our family, to others that we care about, trying to make the world better, whatever those motivations we have are, I think those are the decisions that we're really focused on, where making sound, smart financial decisions is really important. I think for the billionaires, whatever they do, it's not going to really affect their own, it's not going to affect too much their own standard of living. And it just, I think that, I don't want to focus too much on their decisions. They're interesting, though. They certainly are interesting, can be amusing, a lot of food for thought in what their views are.
Sure.
But yeah.
Well, we'll ground it down, and the reason why I focused a little bit more is to the ordinary man or woman, to the layman, to the average investor, to the challenged like myself. There's almost like looking at the market and being able to want to beat the market and want to ride the wave and want to make smart decisions, prudent decisions, and so I picked up a few things. First of all, that the issue with risk is too little can be as bad as too much, or too much can be as bad, not bad, but can, find the risk, the balance, right? We'll talk about the difference between active and passive in a moment. We'll talk about the benefits of passive with, the Oracle of Omaha in a moment as well. But to your point, it's a red herring to be able to say, well, if they couldn't figure out how to earn and keep their wealth, then who are we, and how might we be able to do something differently? And that's why I took you specifically down that direction, which is almost to say, don't look at the finger, right? Look at where the finger is pointing. And where the finger is pointing is to make better, sound decisions that are less based on hype and based on your eyes being bigger than your stomach, and more just based on some new fundamentals.
Yes, no, absolutely. I mean, it was interesting what you said a moment ago, that that taking too little risk can be as bad as taking too much risk. But actually, at some point, taking too much risk can be far worse than taking no risk at all. And just to give you, just to think about a really simple example, let's say that the stock market is stock market has a positive expected return over time above a safe asset rate. And so on the one hand, you might say, well, what if I just invest in treasury bills or some safe government bond, forever, and I forego the return of the stock market. Well, that can be really bad for you. If your level of risk aversion was such that it made sense for you to have half of your money in the stock market, but you were prevented from doing so, let's say, or you didn't do it for some reason, you've really given up a lot of expected welfare yourself. And we could quantify that, depending on the expected return and risk of that we believe the stock market might have. But if you start to go too far in the other direction, and let's say that you say, well, I want to have 5 times, I want to own a leveraged holding in the stock market of 5 times my total wealth. So I want to, I'll go long S&P futures or however, buy call options on the stock market. But if I want to be leveraged 5 times to the stock market because I just think it's going to go up over the long term, well, the risk that just, even though the stock market might have this very positive expected return, if we had done that and go back to 1900 and say, well, what if I just tried to keep myself leveraged 5 times over in the stock market since 1900, because hey, the stock market returned 10% and I could have borrowed at about, on average, about 3%. So it had to have been good. Well, you would have been wiped out several times. You would have been wiped out in 1987 in one day, and you would have been wiped out, at other points in time, depending on how frequently you were rebalancing your portfolio. But at 5 times leverage, you'd have no money today. Whereas if you just kept your money in U.S. government bonds from back then, you'd at least have something, even though you'd have a lot less than you would have had with the right amount of risk. So too much risk is really deadly. And too little risk can be really painful and is really suboptimal. But too much risk is, is just an existential sort of risk with regard to one's wealth.
So what I'm hearing is this idea of, taking the money, putting it away, sticking it under the mattress, doing whatever you need to do, is not necessarily the right approach either. This idea of slow and steady, the consistency, although it's still better than the day trading for the uninitiated. But then, a big part of this is, and certainly from your TED talk, is this idea of active index investing. And I'm going to play a little clip from that TEDx talk, and then we can talk about it.
Taking the best of passive investing, the low fees, the diversification, the simplicity, and marrying it with what's good in active investing. So what is good in active investing? There's more consensus on the answer to this question than you may think. Who wouldn't want to look in the mirror and see Warren Buffett, the Yoda of value investing, or George Soros, the master surfer of market trends and cycles, looking back at us? Buffett's value investing, buy assets for less than they're worth, and Soros's momentum investing, the trend is our friend, appeal to us as common sense principles of sound money management. Why not try to distill and systematize their approaches to investing? It turns out that codifying the basics of value and momentum investing is not so difficult. Of course, a simple set of rules is not going to capture the genius of these 2 legendary investors. However, this active-passive synthesis, let's call it active index investing, will compensate by being super low cost. There's no need for expensive experts. And it will be fully transparent and easy to understand. No magical, mysterious black boxes either. It's just how we imagine that we'd like to invest, and therefore we're much more likely to stay the course and earn the long-term returns that we ought to. And active index investing based on value and momentum, according to historical evidence, has increased return and decreased risk over the past 100 years, all the way back to the early 1900s. So why haven't more ordinary savers converted to active index investing already?
Yes, why?
Well, in some sense, I think that, everybody that's investing in index funds is doing it in some way because, very, very few people put their money into index funds and then never touch that again, or never change their asset allocation again. So you had a lot of people in index funds, and then as we went into the global financial crisis in 2008, a lot of people sold. They got nervous and they sold some of their index funds. Other people thought it was a buying opportunity and bought more equities and rebalanced their portfolios. So there's very few investors, I think, that really just completely set it and forget it. Just put their money into their portfolio and never change their asset allocation again. Based upon that it's just impossible to go through year after year of reading the news, reading the newspaper, seeing how your portfolio is performing, and to not want to touch it at some point and to change it. And so that is a dynamic asset allocation. I think that what I think makes the most sense is to accept that you're going to do that, and to try to codify how you want to do that into a set of rules, so that it's not just one day that the mood takes over you as you read the newspaper of what's going on in the world, and you decide to do something based upon a subjective response to how things are evolving around you, but rather having some sort of an algorithmic, rules-based, disciplined approach, recognizing that you will change your asset allocation. So do it based on some predefined rules that you think make sense a priori. And so you're not making some decision in the heat of the moment when things are going crazy, because I think that is a way that people really do leave a lot of return on the table.
I'm trying to piece it all together, and there is the long game, there is consistency, but it's almost like I use the analogy of Dexter, the good serial killer. He had his code. He had his code. He had his rules. He had his playbook, and he stuck to it. And when he digressed, or when he diverted, or when he broke those rules, that is when he suffered, and that's when kind of the risk increase. Now, we're not talking about serial killers here. We're just talking about discipline, accountability, consistency, staying the course, but at the same time, going back to the master surfer, being able to recognize the changing world and the changing environment and adapting to that.
Yes, absolutely. Yeah. I mean, I think, look, I think that, there's a lot that we've put into our book, and it's hard, to make sense of a lot of the ideas that we're trying to convey in the book. I mean, the book is really a how-to. It's not trying to tell people what to do. It's trying to help people to get a framework for making the decisions themselves that are right for them. And I think that if I were that the most basic ideas that I think are really important in formulating for yourself how you want to manage and grow your own wealth over time, and how you want to spend it down. Again, the purpose of the wealth is to spend it on yourself or on others. That I think that I come back to really two core principles. The first one, I think, if some people call it the golden rule of investing, and that is that we cannot get return without taking risk, but we can get risk without getting expected return. So, that's really the master insight of modern portfolio theory, is that we should get compensated for taking systematic risk, and the more of that we take, the more of that risk we take, the more return we should get. But that there's lots and lots of risks that we can take which shouldn't bear any compensation, because they're diversifiable by people, with big diversified portfolios. So those diversifiable risks, are ways that we could take a lot of risk without getting more return. So it's quite possible to put together a portfolio of 15 stocks that has, say, an expected return of 5% above inflation, but with the annual risk of 30%. Or we can also buy a portfolio of 500 stocks, which also has the same return, but might have half the risk. And that's the most efficient portfolio, is that one that has the highest return to risk ratio. And and the second thing is that when we're making our decisions in this uncertain world, we that taking risk is as much a cost to us as paying fees or paying taxes. It's just that we don't see it in the same way. That when we pay fees, we're giving somebody else some of our money, or when we pay taxes, we're taking some of our money and giving it to the government. When we take risk, we're also diminishing our risk-adjusted return, but we're not actually paying it to anybody. It's kind of like we're paying it. You could think of it as paying it to ourselves in a way, but we need to know what that cost is to make good decisions, just as we need to know what fees we pay, what investment fees we pay, what taxes we might need to pay. We need to be able to quantify the cost of risk. And that's the second central idea that we try to convey in the book. To make good decisions under uncertainty, we have to be able to put a cost on risk.
I mean, this is money, as George Costanza would have said, it's gold, Jerry. No, it wasn't actually George. Who was it that said it's gold, Jerry? It was Bunyan.
It sounds like Kramer. No,
it was actually Bunyan who said that's gold, Jerry, gold. I really love those two golden rules, and what I jotted down the idea of considered risk, measured risk, but also this recognition that risk is in of itself an opportunity cost and potentially an opportunity lost. And I think that was a really good perspective. But it warrants our mention of the elephant in the room, the Gensler elephant in the room, because we are operating at a very interesting time. It's a historical time, potentially, where we're seeing Bitcoin being approved for ETF approval for Bitcoin, and to me, this is part of a diversified approach, no doubt. I would just love to get your thoughts and some intelligence around this. I do want to just say it's very interesting because Gary Gensler, came out and with his cautions, and he basically said, look, if you're considering an investment involving crypto assets, be cautious. So, buyer beware. And then came out with this thread where he basically, is almost saying, look, here are the things, that you need to be aware of, that there is risk associated with it, risk and return, and there's a lot of fraud, etc. So where do you see crypto fitting into this approach right now, in this very historical time that we're living in?
Well, so first of all, there's been a lot that's been written and observed about the SEC's whole approach towards crypto and decentralized finance, etc., where there's really a feeling that that in general the SEC has been extremely active, trying to hold crypto back in every way. And obviously as we all know, they've been losing a lot of the recent court cases, and despite their desire to not have a Bitcoin-based ETF, that the court rulings where they've lost, do seem to open the door to an acceptance that there will be a Bitcoin ETF soon, and maybe other ETFs on other crypto assets down the road, such as Ethereum. For me, there are the number of things that there are to invest in out there or the investment portfolios that one can build from all the things that are out there to invest in is near infinite. I mean, there's just so many different things we can, and then we can have different sizes in them and different combinations. And how do we sort of deal with this paradox of choice that we have? There's so many things that we can put into our portfolios, and everybody is going to come at it differently. So all I can do is tell you how I think about investing and how I think about things such as Bitcoin or commodities or or all kinds of different assets. And for me, to really simplify things for myself and to be able to comfortably arrive at a way to invest for my family's savings, I just really like to invest in assets that have somewhat predictable cash flows. So I like to invest in equities that have earnings and they have dividends. Real estate has rental income, and it has expenses. It's not just pure revenue. There's revenue and there's expenses. It's not easy to know what those cash flows are going to look like over time. There can be a lot of uncertainty around them, but at least I have some starting point for saying my expected return from owning this asset are these predicted cash flows that are out there in the future. And I'm going to try to think about how big those cash flows will be and what kind of long-term return they'll give me. How do they line up against inflation, et cetera? And so I just am really attracted to investing in assets where if I didn't know anything about history, if the only thing I knew was where we are today and the information that's available today about those investments, then I could make a decision about them. And so assets that don't have cash flows are really, for me, they're just too difficult to decide to invest in. So, I don't know how to think about what the return on Bitcoin or any crypto asset or art or NFTs or even commodities. All of these things are really, really difficult for me to come up with an expected return. I can sort of see how risky they are, but the expected return requires me to somehow extrapolate from the past into the future. And if I can avoid that by focusing my attention on those things that have cash flows that are going to generate the return, so I don't need to know or rely upon what was the historical performance, I feel a lot better about that. And so that also pertains, by the way, to all kinds of investment strategies. So if you said to me, how about investing in value stocks? Well, I would say, well, I don't know. I mean, just because value stocks might have done well over the last 100 years relative to growth stocks, it's not enough for me to really want to allocate money to that because it's just, for me, it's mostly an extrapolation from the past. And sure, there's a story. Once you see something that happened in the past, there's all sorts of people. It's always easy to construct a story around it as to why it's going to continue into the future. But fundamentally, if we have to extrapolate from the past to get future expected returns, I feel like I can. I feel like there's enough other things for me to invest in that I don't need to do that. So for me, I'm not really attracted to the Bitcoin investment. I'm not super attracted to investing in gold or commodities, or other things that are just hard to really value. I mean, there are some valuation models, like you think about gold or Bitcoin, there's a cost of mining it. There's an idea that, in the case of gold, that people like it for jewelry, whatever, but I like investing in equities, bonds, real estate, like that gives me enough risk. It gives me enough return.
I was going to say next on my list is pork bellies, but we won't get. But we'll put that on hold on hold for now. I was thinking, there he goes again with all these pesky business fundamentals. But in truth, whether we're talking about cash flow and discounted cash flow, and we've also lived through a world with obscene and irrationally exuberant multiples, especially when looking at tech stocks. But it's interesting to me that it's funny, being serious for certainly, hopefully for more than 1 second. I remember maybe 20 years ago, maybe 25 years ago, just being able to say, I don't know a damn thing about the market and about investing. But I'll tell you, if I was to put all my money in a couple of stocks or a few more stocks, I would invest in Amazon, I would invest in Apple, I would invest in Netflix and in Starbucks. And all I did was identify companies that, from my perspective as a marketer, operated in an environment where they were customer first, customer obsessed, customer centric, where they'd found a particular niche. I just used my own marketing rubric, my own trend analysis. And lo and behold, had I done that, you may have found one of those missing billionaires. But that was how I looked at it. And I think it's not dissimilar to what you're saying in terms of a different form of rubric or code or fundamental aspect of looking at business.
I think that it just feels much more productive to be investing in businesses than sort of investing based upon how other people are going to value something in the future. You know, that if the entire thesis of my investment is somebody's going to pay a higher price than I'm willing to pay today because it's going to become scarce or whatever, you know, I just kind of worry about that. And it might be a good, that, I'm not negative on Bitcoin. I just think that I can, manage my portfolio reasonably well without it. And going back to the beginning comments about the SEC and so on, I believe in free markets, and I think that the SEC in general has taken an awfully aggressive stance on a lot of different on many different aspects of the marketplace, and I don't feel that they've been that effective in saving people from themselves. Even a lot of it is ex post, a lot of it is punitive. I don't know. I'm not so happy with everything that we see out there, but there's many points of view, and it's not really my specialty. So
I love the perspective, and speaking of free market economies and decentralized, but also thinking about the idea of the unbanked and people that previously didn't have access to capital that might, but it still comes back to, I think you touched on it, and I just want to in the few moments we have left, just kind of emphasize that the thesis that you referenced, the flawed thesis, is that if you are hoping to sell that asset at a higher price than you bought it, that means that ultimately when you sell, someone is buying. And so there's almost a zero sum. There's almost this idea that your gain comes at their loss, your benefit comes at their expense. And there's something troubling about that thesis. And I think that's what you were alluding to.
Yeah, and there's also a bit of an efficient market thing that, like, okay, we know that this asset is going to, relative to growth in wealth, growth in population, we know that this asset is going to become more scarce over time relative to that. But everybody knows that, and so we're really predicting We're predicting that somehow in the future there are these people who want to pay more for this thing than I'm willing to pay for it today. It's a little bit disturbing. I mean, I think it can all kind of hold together. It can all hold together and kind of make sense. And I think in the case of Bitcoin, there's this whole story of the institutionalization, the broader acceptance of Bitcoin, and that given that Bitcoin itself is the size of the Bitcoin market is just such a small drop in the value of the global the total global amount of wealth, that for Bitcoin to go up 10x or something like that, why not? Like, the world is not going to be different if Bitcoin is trading at a much higher level. So I think I certainly I'm open to these things, but as I said, I just don't feel that I really need it within my own portfolio. I can keep myself to my principles of trying to invest mostly in things that have some identifiable future cash flows associated with them, rather than being all about extrapolating from the past or coming up with stories for the future that I can say, well, here are these cash flows, and whether they be equities, real estate, fixed income, that gives me comfort, and lets me sleep better at night than the other. But yeah, I think that having a small allocation to anything doesn't really move the needle that much anyway. So whether you say, right?
Moderation, balance. The book is called The Missing Billionaires, and thank God there is a guide to better financial decisions. Do not listen to a word I said, but read this book. And actually, I always like to find one quote, and the quote that I'm going to share is probably a good way to end the show. The quote is, "I will tell you how to become rich. Be fearful when others are greedy. Be greedy when others are fearful." And I think you should know perhaps who said this quote.
And I do. I think it's Warren Buffett. It sounds like to me.
It indeed is Warren Buffett. With all the hype, with all the hope, slow and steady balance. Being able to mix things up every now and then. But it all begins with buying the book. And I mean, it's quite simple, isn't it? I mean, it's very obvious. Victor Haghani, he has published lots of papers. Go to ssrn.com. You can find out about it. There is a very long string which you will not be able to type out, but he has a YouTube channel, and you can see how good he is with the words and the pictures, which I was enamored when I read. But just go to YouTube and type his name, and I'm sure that you will continue to be educated as you read The Missing Billionaires, A Guide to Better Financial Decisions, published by Wiley, who published, I think, four of my 6 books, 2023, and it was named one of the best books by The Economist in 2023. Check out Victor's wealth advisory firm, Elm Wealth, elmwealth.com. And you didn't know this, but it's a fact that you can actually, there is your LinkedIn string, Victor Haghani on LinkedIn. Victor, thank you for coming in and educating this Neanderthal, this ignoramus as well. I definitely feel smarter having having listened to you. And, if there's a takeaway for me, it's this idea that, there's going to be a lot of distraction out there. But when we look, at the bigger picture, and when we look back on this day, it's probably the smarter, strategic, and slightly lesser risky decisions that will prevail. But final word goes to you.
Well, thank you, Joe, for having me on. And yeah, I'm optimistic on overall optimistic on how people are managing their finances. That going back to the 1960s, the median number of stocks that people had in their brokerage accounts was 2. The whole idea of diversification, of getting exposure to the stock market, being in the market for long periods of time. Those ideas are relatively recent. The burgeoning growth of super low cost, super highly diversified index funds that let us invest across 10,000 U.S. companies, 10,000 non-U.S. companies. These are wonderful developments for the welfare of everybody. And I think that there's just been a lot of positive developments over the last 20 years. On personal finance, and I hope it continues. There's much more to accomplish in helping people to get the financial outcomes that they should get, that are available to them just through some exposure to pretty simple sound ideas and the right setup. So yeah, I'm really optimistic for how things are going as regards ordinary. As regards everybody in their investing, really.
And I'll tell you who else is also optimistic about the future is Chuck Norris.
You are Chuck Norris approved.
And we will be back soon. Take care, everyone. Thank you, Victor. Bye-bye.
Thanks, Joe.
Thank you for watching the show about hope, positivity, optimism, and if there's time left over, a little bit of marketing with your host, multiple author, and global keynote speaker, Joseph Jaffe. If you like the show, tell a friend or two. Please subscribe to the show, and if you want to get inside news, previews of upcoming guests, and much more, visit josephjaffe.com/subscribe to sign up for the show's newsletter.
And despite the best ministrations of your wife, you still look ugly.